Next up is a short stroke. This is something we don't use very often, kind of like the Livermore Shakeout Plus 3. It's something that we keep in the toolbox really just when we're pyramiding into a position. It's typically a stock that has superior fundamentals, and we're just trying to get a little bigger position in the stock. So we're looking for places that are good entry points to add to an existing position. It would be very unusual for us to establish a position using a short stroke, but you could do it in certain cases. Maybe you were shaken out of the stock and you were looking for a way to get back in. The first two examples that we're going to talk about are Apple. First one being in the '06 time frame, after it's already had a nice move, had several bases, the last one being a cup with handle, and it's handling itself really nice, shaking out below the 50-day, and then resuming its uptrend. And you have a move up, and then you're holding in tight. And that's really the concept of a short stroke. It's a stock that's already been running, sometimes longer than others, and you have a move up, a powerful move. Sometimes it's going to be a huge move. In this case, it's kind of a moderate move up. They almost always happen with that first move up closing right near the highs, 80, 90% closing range. So that feel is that little hash mark there is almost touching the top of that bar. That's the sense of a powerful move up. After a powerful move up, many times a stock will come down and they'll have a big down week, just kind of consolidating those gains. But with a short stroke, what happens is it doesn't give up any ground. Kind of feels like a very short version of a high tide flag, where you have a flagpole that's a rapid advance, and then you move sideways for a few weeks holding in tight, not giving back those gains. It has the same type of feel as that. So you have a big move up for 1 week, big spread, large price percent change, and then the following week you're closing. Sometimes you take out the prior week's high, many times you won't, and you're just sitting there with a tiny little spread, and that's what we mean by a short stroke. So the stroke being the distance between the high and the low for that second week is very, very small or short, and in almost all cases it'll close up for that week, and it'll close in the upper range, meaning right near the highs for the week. So as it goes through those highs, either the high of that week or the prior week, whatever your resistance area is, that's where you could be adding shares on strength. Again, this is an aggressive way to be adding, so you don't want to be adding a lot of shares. For example, if you've established a position of 1,000 shares in a stock, if you were buying using a short stroke, I typically wouldn't add another 1,000 shares. I just add a couple hundred shares. You're just trying to build that position a little bit bigger. In most cases, this is going to be your best stock, and you're looking almost for an excuse to build it bigger, and you just don't want to just keep buying a stock because you like it and it's making money. You want to look for a logical entry point, and that's where you would use a short stroke. Typically, you're not going to use this very often, maybe a couple times a year. In certain markets, depending on the character of the market or the character of the stock, you might use a little bit more often. So next we're going to talk about a time about a year forward where we're going to be using that same type of short stroke with Apple. So you can see that we've moved up and we went to 86.40, and you backed off and you had some base building in there. Then you've resumed your uptrend. And over here at the short stroke at 102.60, prior to the short stroke, you had that big move up that prior week. Very standard, big gain, closing near the highs, with the following week a very, very minor movement. You can just think of it as resting. It has a big move up in the market, and it kind of backs off and it just slows down for a week, but it doesn't give up a lot of ground. So I would interpret that as people are now comfortable with this new price range. There's not a lot of price discovery going into new high ground or coming back down. It's just hanging in there tight. Everyone's comfortable with it, and most people are just looking for a way to get into the stock or add to an existing position. So that's what you do here as it goes to the highs of those weeks. Whichever week has a higher high, once it takes that out, you're going to be adding, again, just nibbling on the position, not getting crazy. So that was two examples of Apple, that one in '07. All right, next up is Decker's Outdoors. This, of course, was the maker of the Ugg boots. They also had other shoes that they would make and flip-flops, but they were really known for the Ugg boots, and it had a very volatile move. And when you're dealing with a trendy product like that, The moves are going to be a little bit more on the volatile side, but it's certainly worth studying. We traded it a lot here at the firm. It was a good stock to trade, but it's kind of hard to hold on to. We're going to look at early part of its move. It's a little lower price than what we would normally be trading. We tend to not trade stocks under really $12 or $10. So this is on the low price side of things, but it's still worth using as an example to learn from. So what's going on here is base building going sideways during the terrible market and forms it out of base and starts going in an uptrend. So let's imagine that we were buying it as it was coming out of that base and we had a gain in it. And then you have a rapid advance in 1 week, going from $7 almost all the way up to $9 within 1 week. Huge move. And you're studying the product. You're seeing that everyone's wearing these ugly looking boots out there, but they might be ugly, but they're super comfortable. Everybody wants them. And so you know you're onto something special. You want to build a big position in the stock. So you're trying to figure out how do you get a little bit more into it. So you see this short stroke. Again, it's a big move up to 1 week. The following week, it backs off, doesn't hit new highs in this example, and your spread is very small. The distance between the high and the low in that second week is minuscule when you compare it to the prior week. And the close is ideal. It's closing right at the highs. So you're sitting back. You have your buy point now. The buy point is the high of the prior week. As it goes through there, you'd like to see some volume, and then you're adding, just nibbling on it, just making that position a little bit bigger. And look, that's about the only other entry point that you get, except for a bounce off of a 50-day a couple times to really add to this position. And it was a huge move. Goes from originally at $5 all the way up to $30 in a very short period of time. So that was Decker's. Lots of other times to study the stock. And eventually, just remember, with trendy stocks, they tend to end poorly. And that's what happened with this stock. And of course, Crocs, the other shoe manufacturer that was really a trendy shoe, very volatile mover, had an enormous run, but then didn't end well either. So this was Decker's at the beginning of that move in the 03-04 timeframe. All right, last up with the short stroke is Taser. Taser is a stock that we've studied a lot in workshops and here in-house because it was such a huge mover. And really, when we think of Taser, when I think of Taser, I think of all the high tide flags that it made. High tide flag is a very rare basing pattern where you have a flagpole. The stock doubles in a short period of time, in about 4 weeks or so, sometimes a little longer. And then it holds in those gains, not giving up much ground, and then moving higher. So in the same vein of a short stroke, you can think of a short stroke as just a mini high tide flag. And so the character of Taser was these rapid advances up, going sideways, and then having another rapid advance up, just a high tide flag after high tide flags. Really, really powerful mover. And a lot of people were in there shorting the stock, and that's what was driving a lot of the move. This, of course, was the alternative to a handgun. So someone who didn't want to buy a gun where they might have an accidental death, they would buy a Taser, and it became very popular with law enforcement as well. Less lawsuits if you use a Taser versus shooting somebody. So it was a great new product that just kind of came out of the blue and had a huge move up. And then when the move was over, it got pretty ugly, but there's a ton of money to be made in Taser and a lot to learn. One thing I always like to think of is the beginning of the move. It was low price and it was illiquid. So when you're doing your screening, most of the time you want to screen for stocks trading 400,000 or 500,000 shares over $20, $25, but you're going to miss the next Taser if you do that. So if you have time with your screening, open it up to lower price, less liquid, but realize with the lower price and being illiquid, you're not going to have as much sponsorship in there. So the moves are going to be more dramatic, up and down. So you're kind of playing with fire. So I only like to have maybe one thin stock in my portfolio at a time. So let's study the short stroke on Taser. It has been running for a while, broke out, had that high tide flag after high tide flag. Now we're looking at it up here near the $40 range. In the prior week, you have a huge move up and you're closing in the top part of the range. And then the following week, you're hardly giving up any of that move. It's hanging in there very tight, and it's a short stroke, short distance between the high and the low, closing up just a little bit from the prior week, really almost unchanged. And that establishes your buy point. As you go through the highs of those 2 weeks, that's where you're going to be adding to it. Now, it does test you about 2 weeks later. So that's another reason why this is just something you're nibbling on. You're not establishing a new position here. You're adding onto it so you can withstand those pullbacks. And look at the chart, both on a daily chart and a weekly chart. It's very volatile. So a stock doesn't move from split adjusted $4 up to $130 in a short period of time without being volatile. But with risk comes huge rewards sometimes. When you have something that's very unique, fundamentals are there, it's got a new product that really kind of takes everybody by surprise. So here's Taser. I would study this chart for a while because every once in a while you're going to see something like this come along and you want to know how to handle it. So that's how you add to a position using a short stroke.